All right, so the rate cut story from the US looks strong, but now it's time to get your portfolio prepped up to reap the benefits from the new rate cut regime that we might be seeing gaining momentum if all goes well. As far as equity is concerned, is it time to play in the rate sensitive or capital intensive sectors, or if you talk about gold or your debt investment, your fixed income investment, what kind of time horizon should you be looking in for, with what kind of investment options, medium to long term or a long term play even in your fixed income? Let's decode all of this. I have with me Harsha Upadhyaya, a CIO, Equity, Kotak AMC. Harsha, good evening and welcome to the show. And all right, so over the weekend, we all must have read about and heard Mr. Powell's speech as well. But then let's decode this particular rate cut scenario from India's perspective also. I want you to help our viewers understand the kind of rate cut regime that we've been waiting for. The way it decodes and decodes in terms of India play, because on our fundamentals we were already ready for a rate cut, but obviously we just want the major central bank to start off the case. What is your expectation in terms of 25 or 50, the debate that's going on the number? What kind of number do you think is suitable, and its impact on the Indian RBI statement that we might see coming up later on?
Good evening, Kavita. As far as interest rate cycle in US is concerned, clearly we are looking at a shallow interest rate cycle this time around. While the debate is still on whether it's going to be a 25 basis points cut or a 50 basis points cut to begin with, what is very clear seems to be this rate cycle is unlikely to be very, very deep this time around, and we are unlikely to see too many frequent cuts going ahead from this point of time. However, it may or may not have any impact on Indian markets, as some of this is already discounted, and also the fact that India may not necessarily just follow US Fed. To our mind, we believe that even in India, it's going to be a shallow rate cycle this time around. And probably we are unlikely to see any rate cuts over the next quarter or so. And whatever we would see probably will be after December or in the next calendar year, 2025. So to that extent, I think some of these are already discounted in the market. As far as the general interest rate cycle and its impact on the markets are concerned, it's usually positive for valuations and also positive for interest rate sensitive sectors. Having said that, I would again say that much of this is already seems to be discounted in the markets.
Sure. Let's also invite Kaustubh Gupta, co-head fixed income, Aditya Birla Sun Life AMC, for a view on fixed income. Kaustubh, good evening and welcome to the show. All right, so should we be ready for potential gains from falling bond yields if the Fed and RBI cut rates, and we'll see the impact on bond prices?
Yeah, thanks, Kavita, for the time. Yeah, so in our view, we have for sure that unusual noises in the bond market that we have been looking in last 24 months, they seems to be settling down. Fed, which has been the flag bearer of monetary policy for the world, they are seeing some serious risk to their dual mandate target of making sure that the employment market and inflation remains in check. And this gives a lot of hopes to emerging markets, which has been running quite conservative policy over last 24 months. And coming to India, in our assessment, once the external headwinds are behind us, RBI will focus back on local growth inflation dynamic. We do think that RBI is going to cut rates as well. As far as quantum is concerned, that is dependent upon how the growth parameter pans out.
All right. Harsha, let's also talk about FPI investments and their overall strategy when we talk about rate cuts. Do you see them coming back again, and the way we really want? Because overall, the selling pressure from the FPIs that we've been witnessing, thanks to the DIs and retail investors, but we still cannot say that we are a market that can sustain without FPIs. So what is your take on FPI flows around this rate cut timing?
Kavita, once again, I do not see one-to-one correlation between interest rate movements in the global markets and the flows into emerging markets. It's too simplistic an assumption that most investors make at various points of time, thinking that if there is an interest rate cut in developed world, the money will flow into emerging market risky assets, etc. Uh, because many of the mandates may not allow you to shift from one asset class to another, one geography to another. So I do not believe that this alone is going to determine flows into India. Having said that, we have seen very tepid flows into Indian markets for this calendar year. Generally, over a period of, let's say, 12, 15 months, India has always received flows in excess of 15 to $20 billion in the past. This time around, that doesn't seem to be the case. The main reason for that probably could be the relative valuations, which have been quite expensive when Indian valuations are compared to rest of the emerging markets at this point of time. So it's very difficult to say whether just because of interest rate cuts, the flows will start to come back to India or not. However, what is very clear is given Indian fundamentals and Indian corporate earnings growth, return on equity, which have all been very, very superior compared to other emerging markets, and also the fact that Indian weightage in the emerging market basket has consistently been going up and it's second only to China at this point of time, we can safely assume that over the block of next 3-5 years, we are going to get reasonably high level of interest from foreign institutional participation. However, what happens just immediately after the rate cycle begins is very difficult to predict.
But then, Kaustubh, the India rate cut, the RBI rate cut, what kind of BPS do you think, looking at the US rate cut, we'll be able to go ahead with? Would we be following the US rate cut number, or you think we'll have to really think about our particular fundamentals and then go ahead, and we might just not copy the same kind of number, be it 25 or 50, whatever the debate is going on? Kaustubh.
No, clearly, US is significantly above their long-term nominal rates where they have been. For example, if you see last 20 years, US rates or Fed fund rate has been closer to 2.5, and today they are at 5 quarters. So the space of rate cut in US is clearly much more deeper, and the macro data warrant them to not only they cut faster, but also in accordance with the data deeper. Unlike US, India space of rate cut is somewhat limited because India has not hiked rate in the same magnitude. But as far as amount of rate cut is concerned, we clearly see 3 to 4 rate cuts over next 12 to 18 months happening in India as well.
All right. Harsha, let's talk about your sector interest, or maybe how should an investor start playing out this particular trigger in their portfolio now on. Rate sensitive, capital intensive sectors, what's going to be on your radar, your bet?
Kavita, we are not basing all our portfolio decisions just on this particular factor. As you would understand, there are many other multiple factors that would affect markets from time to time. What we have done in the recent times, we have taken out some profits from some of the sectors where valuations have moved on the higher side, and also at the margin, we are likely to see some deceleration in terms of the earnings growth. For example, auto and auto components is one sector where we have booked some partial profits. Industrials, while we still believe that earnings growth is going to be superior, the valuations are slightly discomforting. So to that extent, we have cut some position even in industrials. And some of the money that we have raised by selling exposure of these two sectors have moved into some of the defensive sectors, such as IT and consumption. The thought being at these valuations, it's safer to have some defensive tilt to the portfolio. Not very, very significant changes to our sectoral allocation, but at the margin, we have moved away from some of the sectors where valuations have become quite rich and moved into consumption and IT in the recent times.
All right. Kaustubh, what kind of fixed income play should one be doing now? Can we look at medium to long term outlook, or we still have some interest rate play for short to medium term outlook as well?
So look, in India, the curves have not played out, or they have not come up quite significantly up till now. If you look in terms of data, the real rates in India is near to all-time high, given that our core inflation is closer to 3.75, and a headline repo rate is still closer to 6.5. Over last 24 months, because of the tightness in liquidity and the demand for higher credit, the term spreads are above median, which is why we do think that the yield curve across the board, right from 1 year to 10 year or maybe longer, they can cool off by 50 to 70 basis points once these rate cuts starts being priced in. And in this backdrop, tactically, I would say, of course, for next 6 to 9 months, one should look to long to medium term. But if you're not active investors and you want to just make it more of a cyclical play, then probably the short-term funds and medium-term funds, they make a lot more sense from that allocation perspective.
I think I do have more questions for you, but then right now the time is actually up on the show for this particular segment. But thank you so much, both of you, for taking time out and helping our viewers strategize their equity and fixed income portfolio, keeping the rate cut trigger in mind. Thank you so much. All right, time for a quick break, but then post that, let's shift to our viewer queries section. And also today on the show, we'll be talking about exit strategies from sovereign gold bonds. Since there's a redemption window that's opened if at all your investment has not completed 8 years, and 5 years is actually post 5 years, you can redeem your investment as SGP. But how's it going to impact your portfolio? And if you are seeing a healthy amount of profit, should you be taking this call? And if you do, what's going to be the tax implication involved? We'll get you all these questions answered after this break.